Buckle up, here we go again. We've got the PPI tomorrow morning, we've got CPI next Tuesday, and we've got the FOMC next Wednesday. The market's going to take a fork in the road. Which way is that fork going to lead us? Welcome to the Ready Set Trade Market Minute for Thursday, the 8th of December. Here's a daily chart of the S&P 500. We're going to use the S&P 500 or SPX in this case because it's an excellent proxy for the entire stock market in the US. If we look at the two ends of the spectrum, we have the Dow, which has already erased most of the losses for the year, and you compare that to the NASDAQ, which is still in terrible shape. We want to use the S&P 500. It's what the most professional traders are watching. Okay, so here we are. We've made over a 600-point move off of the bottom, and the price has once again found resistance at this combination of the green 200-day moving average as well as the descending trend line. Everybody sees that. That's no surprise. Now, where people get technical analysis wrong is when they try to use it to predict the future. We're not going to do that. We're going to set up a framework here over the next few days, and we'll use that framework to give us guidance to let us know whether the price is breaking above resistance at this point or setting up for the next leg down. That is the fork in the road that we have to plan for. So let's look objectively at the S&P 500 chart and see where things are right now. So once again, we've seen the price pull back over these last 4 or 5 days or so, down to important support here at 3,900. That is rock solid so far. Former resistance becomes new support from above. So that's played out very well. 3,900 is really the level that we have to watch at this point. Where the market's going to get into trouble is if it rallies weakly over the next few days to a lower high and then sets up with a lower low from there. So this becomes an entire lower high and a larger time frame lower high as well too. Notice how this has happened every single time. We get a weak little rally up to a lower high, and then it just gets destroyed from there, leaving a much larger time frame weekly lower high. And again, we've seen this pattern play out many, many times, and I would expect that we would see this play out again this year. So one of two things will happen at this point. So off of this bottom at 3,900, we're either going to see the price actually break above 4,100 and create that slingshot move. So that would be something that I think few people would anticipate, which is why we have to give it some weight, is a break above 4,100 to satisfy the bulls and to squeeze the bears. And the other move would be a weak rally up until about 4,000 or so to set up a lower high, and then we'd see that break below 3,900. Again, 3,900 is key. If we break below 3,900 on a lower high, then more than likely we are heading to some lower price wherever that is. So this technique is actually called using a Darvas box on the price, and it goes from approximately 3,900 up to 4,100. Although if we do see the price break above 4,000, that's probably going to be a good sign, and especially if it gets above the 200-day moving average and then also the descending trend line, which is going to be before the 4,100. So to some degree, the Darvas box is going to be somewhat smaller than that, but in all cases bounded by 3,900 on the bottom. That's your market minute for today. We'll see you in the next one.